Welcome back to the Algobot channel, where we take apart automated trading strategies and study how they actually work. I'm Algobot, your guide, and today we're exploring an expert advisor for MetaTrader 5 called Bipower Variation Jump Breakout. This one borrows a tool from high-frequency financial econometrics to separate the market's ordinary background noise from genuine, information-rich jumps. By the end of this video, you'll understand how the strategy measures volatility in a jump-robust way, how it spots a real statistical jump, and how it aims to ride the move that follows. Let's dig in. So what does this expert advisor actually do? At its heart, Bipower Variation Jump Breakout is a jump detection strategy. Most volatility measures, like the plain sum of squared returns, blend two very different things together: the smooth, continuous breathing of price and the occasional sharp jump caused by news, a stop cascade, or a sudden lack of liquidity. The strategy uses a technique developed by the econometricians Barndorf-Nielsen and Shepard called bipower variation. Instead of squaring each return, it multiplies together the sizes of neighboring returns. Because one oversized bar only ever appears in a single factor of a single term, its influence is muted. The result is a volatility estimate that is deliberately blind to jumps. It measures only the market's ordinary, continuous movement. That gives the strategy a clean, self-scaling yardstick. It converts bipower variation into a per-bar volatility figure, then asks a simple question of the newest closed bar. How many of those continuous volatility units did this bar just move? That ratio is the jump statistic. When it clears a chosen threshold, the strategy treats the bar as a genuine jump, a move far larger than the quiet regime could plausibly have produced on its own. Because jumps tend to carry information, price often keeps drifting the same way for a short while afterwards. So the strategy enters in the direction of the jump and aims to ride that continuation. Every signal is confirmed by a surge in tick volume, and risk is handled with stops and targets scaled to the average true range. It's designed for liquid currency majors on intraday timeframes, and it's a great case study for anyone curious about volatility modeling and market microstructure. Remember, this is educational information only and not financial advice. Let's walk through the exact logic, step by step. The strategy works on closed bars, so it only evaluates a new signal once a fresh bar has completed. Before doing anything else, it runs two housekeeping checks. First, it confirms there is no open position for its magic number. This strategy holds only one position at a time and lets the stop and target manage the exit. Second, it checks the current spread. If the spread is wider than the maximum spread setting, which defaults to 30 points, it stands aside so that fills stay realistic. Next comes the volatility baseline. Over the look-back window, 20 bars by default, the strategy calculates the log returns of each bar and sums the products of neighboring absolute returns. It scales that sum by pi over 2, the standard bipower correction factor, and averages it down to a per-bar variance. The square root of that is the continuous sigma, a volatility figure that stays calm even when a single jump has just occurred. Crucially, the window ends at the bar before the newest one, so the candidate jump never inflates its own baseline. Now the strategy measures the newest bar. It takes that bar's log return and divides it by the sigma to produce the jump statistic, which it calls Z. This tells us how many units of ordinary, continuous volatility the latest bar just traveled. If Z is at or above the jump threshold, 3 by default, the bar is a significant upward jump. If Z is at or below -3, it's a significant downward jump. But a large move alone isn't enough. The strategy also demands real order flow behind it. It compares the jump bar's tick volume to the average volume over the same baseline window. Only if that volume is at least the volume factor times the average, 1.5 times by default, does the signal stand. This filters out thin, illiquid prints that can spike on very little participation. When both conditions line up, the strategy acts in the direction of the jump. For a long, it buys at the ask. For a short, it sells at the bid. Risk is defined by the average true range. The stop loss sits 2 times ATR away from entry, and the take profit sits 3 times ATR away, a reward-to-risk ratio of 3:2. From there, the position simply runs until it reaches one of those two levels. It's a clean, rules-based approach. Let's look at the actual MetaTrader code driving this. At the top are the input parameters, which mirror the strategy's settings exactly. Lookback sets the window for the jump robust Bipower baseline, defaulting to 20. Jump threshold, at 3, is how many continuous sigmas the latest return must exceed to count as a jump. Volume factor, at 1.5, is the volume confirmation multiple. The ATR period, stop multiple, and target multiple control the average true range stop and target, and there's a maximum spread gate, a fixed lot size, and a magic number. Just above the two signal blocks, you can see the key line. Z equals R0 divided by sigma. That's the newest bar's log return, scaled by the jump robust volatility, giving the signed jump statistic. The first block is the long side. The condition reads, if Z is greater than or equal to the jump threshold. When that's true, and volume has already been confirmed earlier, the strategy grabs the ask price, sets the stop loss below entry by the ATR stop distance, sets the take profit above entry by the ATR target distance, and calls trade.buy. The second block is the mirror image for the short side. The condition reads, if Z is less than or equal to negative the jump threshold. Here the strategy takes the bid price, places the stop loss above entry, the take profit below entry, and calls trade.sell. Both sides normalize their prices to the symbol's digits before handing the order to MetaTrader. Simple, symmetric, and easy to follow. Now let's bring it all together on a chart. On screen is a Eurist 15-minute example. Below the candles is a subpanel plotting the jump statistic, the z-score of each bar's return against the jump robust volatility. Two dashed lines mark the thresholds, one at +3 for upward jumps, and one at -3 for downward jumps. Whenever the statistic pushes into the shaded band beyond either line, the strategy is looking at a genuine jump. Look at the first few candles on the left. They're small and quiet, tight little bars drifting sideways with barely any range. In the subpanel, the jump statistic hovers close to 0, wandering gently between plus and -1. This is exactly the calm, continuous regime the Bipower baseline is built to measure. Nothing here is unusual, so the strategy simply waits. Then everything changes. A large bullish candle prints, far bigger than anything before it, surging upward in a single bar. In the subpanel, the jump statistic leaps up and pierces the +3 line, climbing well into the upper band. That's the signal. The latest bar moved several times further than the quiet regime could normally produce. And notice the volume. This jump bar arrives on a clear surge in tick volume, comfortably above 1.5 times the recent average, which tells the strategy there's real order flow behind the move rather than a thin, illiquid print. Both conditions agree, so the buy entry marker appears, and the strategy enters long in the direction of the jump. From there, watch how the idea plays out. Because jumps tend to carry information, price often keeps drifting the same way for a short while, the market underreacting and then catching up. The next couple of candles continue higher, extending the move. The take profit sits 3 times the average true range above entry, and as price pushes up into that level, the take profit marker is hit. The long trade is complete, closed at its target. Notice the strategy never had to guess a top. It simply rode the continuation until the ATR target was reached. After that, the market settles down again. Several more quiet bars form, and the jump statistic sinks back towards 0, staying well inside the 2 thresholds. The strategy is patient. It holds only one position at a time and waits for the next genuine event rather than forcing trades in the noise. Then the mirror image unfolds. A large bearish candle appears, dropping sharply in a single bar and dwarfing the quiet candles around it. In the subpanel, the jump statistic plunges down through the -3 line and deep into the lower band. Again, the move comes with a matching surge in tick volume above the confirmation multiple, so the strategy treats it as a real downward jump. The sell entry marker appears, and the strategy enters short, once more in the direction of the jump. Price then follows through to the downside. The next bars continue lower as the move extends, and the take profit, placed 3 times the average true range below the entry, comes into play. As price reaches that level, the take profit marker is hit, and the short trade closes at its target. So across both trades, the pattern is identical. Quiet, continuous volatility keeps the jump statistic near 0 and the strategy on the sidelines. A sudden move that clears the 3 sigma threshold, backed by a volume surge, is flagged as a genuine jump. The strategy enters in the jump's direction, sets an ATR stop below or above the entry to define its risk, and targets a move worth 3 ATR for a reward to risk of 3 to 2. Of course, not every jump continues. Sometimes price reverses and the stop is reached instead. That's why the risk controls matter, and why this is a study in probabilities, not certainties. And that brings us to the end of our breakdown of the Bipower Variation Jump Breakout Expert Advisor. We've seen how it uses bipower variation to measure volatility in a way that ignores jumps, how it z-scores each new bar to spot a genuine statistical jump, how it confirms the move with tick volume, and how it manages risk with ATR-based stops and targets. Remember, everything here is for educational purposes only and is not financial advice, a recommendation, or a solicitation. Trading carries real risk, and losses do happen. If you found this useful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment telling us which strategy we should study next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.